bearish. When it's nowhere near bearish, it's all bullish. So you have to look at the contrast between what is the imbalance and how does it trade there. It changes its state of delivery, not a singular one candle down like it does here. It's doing something, and you have to think about what is it doing. What I just outlined here, it's putting in more sellers. And once it does this and rebalances, the algorithm is not aware of how many people bought or how many people sold. It doesn't know that. It doesn't know your specific stop. They don't have that there's no book like that, okay? The idea is everybody's stop is going to be where everybody's stop is, because everybody's drinking from the same pool and the water's tainted. It's the same stuff I taught on baby pips in 2010. We have not changed or deviated from that. Price starts to reprice higher, and it cues all the traders that will be waiting for this signal here that is aware of what the algorithm's doing. Once they see this break here, that's a shift in market structure on the bullish side. Now, again, what changes? We are now in alignment with the buy program after it's been rebalanced and overcome this impulse of sell side liquidity. It's been flooding the market here on two levels, with buyers trying to buy here and they run at, or they go down and then go down again, rebalancing this buy side area here. So it's not like usually you expect like a single up candle and then over here a single down candle and it rebalances. It can happen that way, and that is usually a consolidated range environment where it'll rebalance like that. But generally a strong trending market, you'll see something like this many times if you drop down lower time frames and you look inside this imbalance. So what may not be showing on a hourly chart here, this same thing could occur in a 15-minute chart where it's drops and then drops again. So it's giving a trap basically for traders that want to chase it going lower, thinking this is a bear flag and they're going to look for it to go down in here or maybe into these levels or this old low. So we can forget this whole retail logic. Okay, that's nonsense. It's absolutely nothing like that is going to give you consistency. It's going to give you more reasons to have a losing trade than it is going to give you precision. So the market starts to trade higher as a result. And then we have to go back to this old high, which is a high resistance liquidity run signature. So notice what happens here. The algorithm goes real close to it and then drops. So it's a delayed delivery above here, which is exactly what you expect in a high resistance liquidity run. So while this is going up, it's going to be met with a lot of tug of war back and forth before it clears it. Okay, so watch what happens when you see these failures to go above a high resistance liquidity run and it starts to retrace. Your eye should immediately go to wherever there's an imbalance, because that's why it's going down there, or it's going below a short-term swing low. Well, there really isn't a swing low of any importance here that I like that isn't really pushed to the sidelines because of this clear, obvious buy-side imbalance, sell-side inefficiency. So you can see the discount fair value gap here. Why is this a discount? From this low to this high, 50 is equilibrium. We were below it, and it's rebalancing. So the bottom line is all we're doing is giving structure and context as to why price should be delivered as it is. But look what's happening. The same thing that's occurred down here, there's a change in the state of delivery. Buy-side imbalance. All of this right here is the same thing all this was. This drops down, and the fact that it drops down into this area here, there's a change in the state of delivery. But it's referencing an old delivery where it's been buy-side only. So where do the signals form? Where do the order blocks? Where are the fair value gaps? Where's the breakers? Where do these PD arrays? Where are the ones that work? How do you figure out what they are? When the market trades down into it, that sell side delivery of price into a buy side imbalance, that's when the algorithm will reprice and go higher. Now this one overshoots a little bit. Now this tail on this candle, if you go through, I think if you go through TradingView and look at all of the different data feeds, you'll see that this low is different pretty considerably across the board. And If you have live accounts, look at your own low there as well, and you'll see there's a discrepancy between what your low and all these other lows will be, because this is a run on liquidity. That's the part that makes this difficult, because everybody wants it to stop exactly at that high when it's not necessary. All we needed to do is trade into the fair value gap, and we allow for it to trade down below this low. Now, that may be more pips than you're willing to assume. Well, then don't trade the 60-minute chart. Wait for it to close it, and then create another fair value gap or a bullish order block on a 5-minute chart or a 1-minute chart, and you'll capture something in there. Then price runs above. The delayed delivery is now ran into buy side liquidity here above this high. So once it hits that, what happens? We refer back to what? This is a high resistance liquidity run. So it does go above it, but look what happens. The market changes its state of delivery again, goes back down into the bullish order block, hits it one more time, and trades to the top of what? The fair value gap. They do not expire outside of the range of the IPTA data range. That's how I stop looking at them. Now, if they become sensitive again because of price action and recent delivery, then I'll start following them if they're outside of 60 days. If they're older than 60 days, but they're starting to show sensitivity again, then okay, fine, they're going to be reclaimed. But I don't like to look at a PD array above 60 days and expect a lot of sensitivity. It can happen, but I don't choose trades around that. And that's why we have IPTA data ranges, 20, 40, and 60-day look back. But the fair value gap, it trades to it here, finds the support with an order block, optimal trade entry. So what's the narrative still? Are we bearish? No, we're not bearish, we're bullish. So the market starts to deliver price on the upside again, goes above this short-term high, and then what happens again? Another retrace. What's it retracing to? The order block, which is that down close candle right there, and that fair value gap. The state of delivery here is buy side only. What does it do? It trades down into it. The sell side, at the time it trades into the imbalance of the buy side, at that moment, the algorithm changes gears. It shifts. It changes its state of delivery. It's not buying pressure. To say that kind of stuff, that means like looking at charts from 1950, 1930. Okay, go back and look at all those charts. You'll see these same things occurring. You're trying to tell me that everybody was using what I'm teaching you right now? No. The market makers were turning price at that. They stopped offering lower prices because they knew how far they were going to take it down to. It was all manual then. Everything was manual. It was a group of men that would literally sit around and say, okay, we're not going to offer any more pricing lower. That's it. And then they would start offering prices higher. And then you as a trader see that and say, oh, they're bidding it up. Who's bidding it up? The traders, they're buying it up. That's not what's happening. It's they're controlling it. Whose storehouse is this? The market maker. Well, if we're talking about currency, who's the storehouse owner? The central bank. So whatever price they offer, that's the price feed that everybody deals with. Okay? So if you have a broker or a dealer, that desk has to work with the price that's been given and piped into them. They have no control over where that price is going to go. The only control they have is the spread. They can make that as wide or as narrow as the law will allow, but they have no control over the delivery of where that price is going to go ultimately. This is what I'm teaching you here. Every element of your study needs to go into studying the narrative, who is getting harmed, who's getting tripped, and who's getting manipulated, and for what reason. When you flesh out your charts like this, it will give you a plethora of treasures to mine all the time, and you'll be able to go back to it and refer to it at a later time when there's more price action, and you'll see how all these things start to dovetail together. It's one thing for me to sit in front of you every week and say, this is where I think it's going to happen, and by the end of the year, it's going to look like this on your chart. And then when it happens, it's like, wow, it happened. And you forgot all the time in between. So this is what you do. You go through your charts and you fill in all those gaps where you thought it was just nothing to be paying attention to. This is what I'm referring to. It's very expensive here. You have to spend time in your charts. You cannot get this information from me doing it. I can do 3-4 hour long videos. It's still not going to scratch the surface of you going in and seeing it yourself. Because there's many things in this chart here that I'm not pointing to, not because I don't want to talk about it or not because it's not something you've already learned or that I'm hiding it from you. It's just because of the scope of time doesn't permit it. Like there's so much more to talk about. For instance, we have consolidation here. Market runs up and we have a breakdown. This is a market maker sell model. What? Yes, this is a market maker sell model. But remember, the sell model can sometimes reaccumulate over here and not run out the original consolidation. Oh, that's all part of this same fractal as well that supports the narrative. But then you have this market maker buy model. Consolidation, breaks, returns to consolidation, smart money reversal, low risk buy, reaccumulation, another level of reaccumulation, and boom, clears the original consolidation out. Everything will start to dovetail once you start putting the pieces together modularly. You have to do it bite-sized. You cannot eat the elephant with one gulp. You got to take one bite at a time and expect to spend a lot of time. You're learning the most difficult thing on the planet because you're standing in front of yourself saying you can't do it or it's too hard. When I'm just telling you, it's going to take work. It's going to be hard in the beginning because it's hard like exercise. Nobody wants to do it. But once you get into it and you start doing it for 60 days, if you can work out consistently for 60 days, then you've overcome that initial hurdle. And it's pretty easy as long as you continuously take yourself to the gym or work out. You'll be able to be fine with it. This is no different. You have to replace bad habits with something else. And it takes about 60 days to do that. So if you go through your practice of every single day, spending about 30 minutes, maybe as much as an hour, but I wouldn't do anything more than that. But you have to do it every day. Go into your charts, really annotate them, study them, think about why would have done something like this and why is it doing what's doing over here? What's it trying to do? Okay, and then look for when the state of delivery is changing, okay, when it's opposed to the underlying narrative. It's bullish back here. It's bullish right here. It's here and here. Every single time it's trading down into an area where there was buy side delivery offered and the delivery is changing its state to sell side and overlaps with that moment when it was buy side, that is efficiently balanced. That means at that moment, that's when you anticipate the algorithm changing gears. Not buyers are coming in or sellers stop losing momentum or start losing momentum on the sell side and now buyers take over. That's not what goes on. That's not how this works, folks. I know it feels like it because you have so many books that tell you that and so many people you probably have a lot of respect for. That's not me, okay? And they tell you this stuff over and over again. It's buying and selling pressure. It's supply and demand. It is nonsense. This is absolutely a Ponzi scheme, okay? It's always been that way. It just gives you all these reasons to think that it's something that it's not, okay? Because if they can tell you that it's those things that you readily admit that they're going to fail a lot, and you can be profitable if you have 5-to-1 reward to risk ratio. What does that mean? That's saying that you could be 60+% wrong. And that you go into that thinking, well, I could be 65% wrong and still be profitable. Are you going to go to a job and say, hey, look, you're going to work 65% of the time and not get paid? You're not going to work that job. But that's what they're doing. They're giving you that coming in the door, and nobody's going to sit down and frame a trade that's 5-to-1 or more. They don't have that skill set because they don't have this skill set here to sit down and have a real interest in understanding the fine details of why price does what it does. You have to have a narrative. What is it doing? Is it going to go higher or is it going to go lower? Why? What makes it bullish or bearish? That's what I teach you. Relative to that weekly chart. Is the next weekly candle going to expand to the upside or is it going to expand to the downside? That's your number one question. What's going to happen on that weekly candle? You're not predicting the close. You're not trying to predict exactly how high it's going to go. You just need expansion. Okay? Once you have expansion, that means opportunity. And you work within that bias. And if you're wrong and it doesn't go in that, then you're wrong. It's nothing wrong. It's not going to kill you. But once you have that narrative, you stay with it. And you look for all of these little pieces of the puzzle because they're not going to hide it from you. They can't. That's the beautiful thing about this. When you understand the state of delivery and when it changes and then it overlaps where it was a previous state of buy side and it offers it into sell side, as it's trading down like that, every retail book out there says nothing about buying when it does that. They like to see it when it's already turning okay, or they're looking at an indicator. And once it goes down here and hits this, there is a bullish divergence. If you look at an indicator right there, that's when they work. But it's not because the divergence is there. It's because the narrative overlaps with what I'm showing you here. The delivery of price controls everything, and it's hinged on time and price. Once you have that and you understand the states of delivery where it's buy side then changes to sell side, when you're bullish, that's where the signals are going to form, because the algorithm will turn on a dime there, like it does here and here and here. Think about it, folks. Before you met me, before you did any of this study with me, okay, you never saw turning points like this and understood why it was happening anywhere. It was not in supply and demand, not in Elliott wave, not in support and resistance, none of that, harmonic, none of it. None of it had this level of precision. But you're learning the highest order of precision there is in these markets, because you're learning exactly what makes these algorithms turn, and when they reprice, and how they should price aggressively one-sided, or how they do it in a sputtering context like this. I'm teaching you how these markets create these choppy but eventual run through. You never learn that in a retail book. You never see that. Folks, I got over 2,000 plus books, and I'm telling you, I've never, ever, ever seen anybody teach the idea of a high resistance liquidity run. It doesn't happen. It does not happen. But you're learning that. What's the benefit of that? You can trade in them, but if you can understand also what they look like here, while they're still profitable, it's better to focus your time and energy on low resistance liquidity runs, because you're going to get that immediate feedback. You're going to get that easy run to your target. Doesn't mean you're going to 100%. It just means that you'll find, in contrast, that that's the easier way of trading. And by knowing what these trades look like, you can filter out your expectation of fast runs while it's like this, but still submitting to the idea that it's a higher time frame premise. So it's just going to take more time for your targets to get through, and not trail your stop loss up so aggressive and so fast, because you're going to get these types of movements where it's whipping back and it'll stop you out before the real move takes place. So hopefully you got something out of this, and until I talk to you next time, it probably won't be until 2021. So just let you know, it'll probably be Sunday. We'll have this weekend's teaching, because family plans came up, and I'm not going to have the time to sit in front of the charts and the computer to build up your weekend lesson. So until I talk to you next time, be safe and Happy New Year.